The Australian economy is recovering strongly from the pandemic, and one of the signs of this recovery is the rise in wages for workers across the country. According to the latest data from the Australian Bureau of Statistics, or ABS, wages grew by 3.7% over the year to March 2023, which is the highest annual increase since 2012. This means that workers are getting paid more for their work, which can boost their living standards and spending power. But not all workers are getting the same pay rise. The main driver of wage growth was the private sector, which saw a 4.1% increase over the year. The private sector includes businesses that are owned and run by individuals or groups, such as retail shops, restaurants, factories, and farms. The private sector employs about 85% of all workers in Australia, so its performance has a big impact on the overall economy. Within the private sector, some industries did better than others. The ABS data shows that a number of industries recorded annual wages growth above 4%, such as healthcare and social assistance, 4.8%, construction, 4.6%, education and training, 4.5%, and professional, scientific and technical services, 4.2%. These industries are in high demand for skilled workers, especially as the economy recovers from the pandemic and needs more healthcare, infrastructure, education and innovation. So why are wages rising faster in these industries? One reason is that there is low unemployment in Australia, which means that there are more jobs than people looking for work. The unemployment rate was 4.6% in March 2023, which is the lowest level since 2008. This means that workers have more bargaining power to ask for higher pay or look for better opportunities elsewhere. Another reason is that there is a tight labor market in Australia, which means that there are not enough workers with the right skills or qualifications to fill the available jobs. This is partly due to the border closures and travel restrictions that have reduced immigration and international students during the pandemic. This means that employers have to compete for workers by offering higher wages or other benefits. A third reason is that there is high inflation in Australia, which means that the prices of goods and services are rising faster than usual. The inflation rate was 3.8% over the year to March 2023, which is above the Reserve Bank of Australia's target range of 2 to 3%. This means that workers need higher wages to keep up with the rising cost of living and maintain their purchasing power. These three factors, low unemployment, tight labor market and high inflation, have created a favorable environment for wage growth in Australia, especially in the private sector and some of its industries. However, this may not last forever, as there are also risks and challenges ahead. For example, if inflation becomes too high or too volatile, it could erode workers' real incomes and hurt consumer confidence. Or if interest rates rise too quickly or too sharply, it could dampen business investment and hiring. Or if new variants of COVID-19 emerge or outbreaks occur, it could disrupt economic activity and recovery. Therefore, it is important to monitor how wage growth evolves in Australia and what it means for the economy. Wage growth can be a positive sign of economic health and prosperity, but it can also be a source of uncertainty and pressure. As always, balance is key. The wage growth in Australia has reached a 10-year high of 2.2% in the September quarter, according to the latest data from the Australian Bureau of Statistics. This is a sign of a strong recovery from the pandemic-induced recession and a tight labor market with low unemployment and high job vacancies. However, this does not mean that Australians are better off financially. The wage growth is still lower than the expected inflation rate of 5.5% by the end of the year, as measured by the Consumer Price Index. This means that the prices of goods and services are rising faster than the incomes of workers, which reduces their purchasing power and living standards. In other words, Australians are getting more money but they can buy less with it. This is a problem for the economy because it can dampen consumer spending and demand, which are key drivers of economic growth. It can also increase inequality and social discontent, as some groups of workers may face more hardship than others. For example, public sector workers have lower wage growth than private sector workers, and low-income earners have less savings and assets to cope with rising costs. Therefore, the wage growth in Australia is not enough to keep up with the high inflation, which poses a challenge for both the government and the central bank to balance between stimulating the economy and controlling the price pressures.